Hey everyone, my name is Siddharth. Welcome back to Sidharthworld, your own channel. I'm sorry the voice will be a little low because of the health issues. I will try to make it up in the editing time. But in this video of the art of investing, we have understood in the last video what is investing and why investing is necessary and all. In this specific blog, we are going to understand the basics of investing, or what are the basic investment fields that is available. So in order to tell you, I will put a chart soon after this, but the first or the three types of investing that you can do is stocks, then bond, and then real estate. Majorly the investment happens in these three sectors. Whether you are good at investing, so you will be buying on stocks of the companies after doing their analysis, their fundamental analysis, technical analysis, understanding their profitability, promoters holding, all that things, and you will decide which stocks to invest, how much to invest, and all that. Then you have got bonds. Bonds are of another, again, two types, and all that we will discuss in detail. And then real estate. And real estate has got little tricky because not everybody has that much amount of money to invest on real estate, because real estate, it's a capital intensive business, or it's a capital intensive. So if you invest as fixed at least a benchmark amount, then only you will be able to get a good return on it. So let's see how to differentiate these three things and how to understand which one is the right investment for us. So we will again study at the end, but for this vlog we will summarize that also. Now the very first thing is, investing has three categories or three types. As you can see in this chart, there are three types of investment. One is your stock, one is your bonds, one is your real estate. Now I have further subdivided, saying stocks have got two types, preference share and equity share. Bonds have got two categories of bond, government bond and corporate bond. And your real estate has got two. One is a property investment, one is a REIT. Now, what are these three things? So just to give you a perspective, REIT is nothing but real estate investment trust, which means you decide somebody and invest. In the upcoming video, in the further topic, and when we go to the real estate part, I will explain you. First, stock, preference share and equity share. There are always two types of stocks or shares that a company floats. What is a preference share? One is a equity share. Equity share is nothing but what happens when you invest in an equity share, you get a ownership of a company. Whether it is one share, whether it is two share, whether it is 10 share, you become a part of that company, which means your name is getting registered into the register of members, and you become this. When the AGM happens, you get the invitation and all. That's equity share, which means you are a part owner of the company. When it comes to preference share does not give you any voting rights. It does not give you any ownership. The only one thing that promise you is, I will give you a fixed return. A company says, okay, every quarter I'll give you 5% return, or every quarter the dividend is declared, I'll give you 5%. So which means in a year 20% will be your return. Plus minus what is the value of your investment amount, whether it is plus, minus, low, high, does not matter. It is going to give you on the number of units. You have invested, you have got 10 shares of XYZ Limited, and you have invested, now that X minus 1 it is, does not matter. You had invested 10x amount, now it is coming to 9.5x, does not matter. You get a amount. A percentage is given, a percentage of the profit will be shared to you based on the number of holdings. Now for equity share, what happens is, an equity shareholder has the right to call for the investment, like can check with the records, can ask them the questions. And in long term, equity shareholders get a benefit because you can keep on increasing your stake, and the board of the directors decide how much is the dividend to give. In a preference share, the portfolio itself or the prospectus itself will have a line, a point which states how much percentage the company has decided to give you as dividend. So that percentage every quarter you will get. The percentage will not remain same till the time you are holding. The percentage will remain fixed, which means if it is 5%, it is 5%. It won't change, and there is no compounding effect. It's 5% only. But in equity share, what happens? Or a part owner, you have voting rights, you have all the privileges and all. The only thing happens is it depends how much is the dividend the company is deciding to give. Now the company says, okay, I'll give to my equity shareholders 50 rupees per share. So if I'm holding 10 shares, I'll be getting 500 rupees. If I'm holding 100 shares, I will be getting 5,000 rupees. If I'm holding 1 share, I'll get 50 rupees, and that amount will be credited to my bank account. Once the board meeting happens and once the board of directors confirm and they sign the resolution stating yes, we can go ahead and we can give dividend because we have money, they will give. It does not confine to saying that equity shareholders will always get dividend. Let's say if the company has got some future plans to set up a new factory or a new plant, rather than giving the return, the company will invest that money into that project. Now what happened? That money company will use at a later stage. Company might give a higher one. If company wants to give 50, now instead of giving 50, that amount company will reserve it and will invest and will give. But that is not the case. They will only reserve the amount that was going towards equity shareholders. When it comes to preference shareholders, they will have to pay it poundly, because that's a preference share is like a debt kind of thing. They have to pay them without any hesitation. But to equity shareholder, they can take the liberty. Now that is about your shares. Now what you need to do in terms of doing the investing the shares is you need to have a demat account with broker. It is always preferred to have a demat account outside of your bank. All the banks provide, but banks will charge you a lot of money because of the maintaining of the accounts. So it's always better to go and find a platform which will provide you a demat account and will not charge you any annual maintenance cost for investing. For trading, they will charge. That's a different thing. We are not talking here trading. We are talking about investing. So always remember, find a platform, whether it is Grow, whether it is 5paisa, whether it is Zerodha, whether it is any other platform. Understand, read and see to that it meets your requirement, because initially when you are starting to invest, you are learning, you are doing that, so you cannot afford to pay huge amount of annual maintenance fee that will be charged, and you cannot give that. So what happens? Find a platform which does not charge you anything, which means you can have an account. Now all you have to need is you need an ID, Aadhaar card and a PAN card, and just follow the process. You have to open the account and it gets open in about 2-3 hours, and then you attach your bank account and then you start pushing the money. Pre-COVID, there was a condition that if anything, any amount that you top up in your broker's wallet and then on your account wallet, and then you start doing the trading, and something left out which used to be stored in the account itself, so that money is lying with the broker. But what RBI said is the broker should not do misuse of the money. So the broker said is every Friday, once the trading hour, once the market closes, the broker has to settle out the payment, which means anything which is left out in the account, they will have to push it back to the bank account of it. Which means if whether you have top up your wallet with 1000 rupees, you only did the investment for 900 rupees. That 100 rupees whatever is left out, that broker cannot keep. So Friday evening that amount will get credited to your bank account, because broker has to release it. So broker has got nothing. Broker only makes a margin when you are making a profit. What happens now, there are two more terms which is called STCG, short term capital gain, and long term capital gain. That I will take it in a different video, but just to give an idea, anything within 1 year period or 12 months period will be considered as a short term capital gain. Anything above 12 months period will be considered as a long term capital gain. The same thing, short term capital loss, long term capital loss. If you keep it for more than 1 year but you still incurred loss, that is there. If you got within 12 months you sell it and you still incurred loss, that is also considered loss. Another interesting part is, if you invest and let's say you invest in two stocks, ABC Limited and XYZ Limited. XYZ Limited made a profit, ABC Limited made a loss. What happens? You made a profit of say 50 rupees and you made a loss of 25 rupees. So the difference is, you made a 50 rupees profit, but you should pay now the tax. Here you made a 25 rupees loss, so this 25 rupees loss will be set off against that 50 rupees profit, which means you left out with 25. On that 25 rupees only you will pay the tax, which means whether it is 15% if it is short term, or whether it is long term. If it is long term, let's say 2.5%. 2.5 rupees you have to 25 rupees, so 2.5 rupees you have to pay. That's because you have already set off your losses. So your losses can be set off against the profit, and whatever left out is based on that the tax will be calculated. Now that's one thing about the stocks.